Good afternoon, everyone. Distinguished speaker, Ms. Chen, Privacy Commissioner Chong, and Senior Manager Ho, ladies and gentlemen, good afternoon. On behalf of the Asian Institute of International Financial Law, also known as IFO, I'd like to extend our warmest welcome for you to join today's public lecture titled Virtual Banking and Beyond, as we delve into BIS paper number 120. My name is Emily Lee. I'm the director of the IFO. I'm truly honored to introduce our speaker today, Ms. Sally Chen, who is the lead author of the BIS paper. The paper offers a thorough and insightful analysis of virtual banking across various jurisdictions, including China, Hong Kong, Singapore, Japan, Korea, and more. Sally is currently the regional advisor for the Monetary and Economic Department in the Bank for International Settlements, BIS, Asian office. Before joining BIS, Sally was with the International Monetary Fund, IMF, in various capacities, including assignments in the fund's strategy department, where she helped draft the fund's policy stance on exchange rate policy and debt management. More recently, Sally was the resident representative heading the IMF's Hong Kong office, where she coordinated the fund's research efforts on financial market developments and outreach in the Greater China region. Please join me in extending a warm welcome to our distinguished speaker today, Ms. Sally Chen from the BIS. Without further ado, I now pass the floor to you, Sally. Thank you.
Thank you, Dr. Lee, for that very kind and really generous introduction. It's a pleasure to be here. It's an honor. I have to say that I am here because my co-authors and I have worked on this paper. I'm certainly not the lead author. In fact, this was the idea that my previous boss, Siddharth Tiwari, that this was his brainchild. He had the foresight to say, you know, this is something that's interesting, that's not within the regular purview of BIS, and we should look into it. So we worked on this paper. And when we drafted this paper, we had some inkling that this could be revolutionary in terms of how it might change finance. But we had no idea when we wrote that paper the implications on data management and what that means in this day of fevered discussion on generative AI. So it's really a pleasure being here. And what I hope to do today is present to you some of the thoughts and ideas we have on virtual banking coming from the perspective of an economist. So my job here is to raise some of the issues, share with you what we're thinking, and certainly look forward to benefiting from your expertise. Okay, so let's get started. So just give you a sense for what I hope to do today. 3 parts, and I hope to wrap up the first 2 parts fairly quickly so we can talk about the third part. So the first part really is just talk about essentially our motivation. Why did we look into this in the first place? And this has to do with financial inclusion, and that's actually something that I've spent quite a bit of time in my career looking into, and it's a personal passion of mine, talking about some of the gaps and challenges and how virtual banking can come in. What it means in terms of virtual banking, in terms of technology that allows these digital banks to help plug some of the gaps, and what it means given this new technology and platform that potentially revolutionize finance. What does that mean in terms of the opportunities out there and the risks out there? And lastly, a critical part of the discussion is, well, what does that mean for regulation? For governance, how should we think about this? And in particular, I want to save some time to talk about data governance and data management, because the crux of what makes virtual banking possible is this whole idea of access to data, this whole idea of information capital. So this is a chart that we have in our paper. And it is based on a set of data that's actually a few years old, but it tells the story quite powerfully. This is from the World Bank Findex data set. So if you look at the first set of bars, the first panel on your left-hand side, you see that roughly 2/3 of the world's population have access to formal banking, right? That's a big red chunk there. And if you look at the middle bar, the second one, you see that roughly 27% of the population report setting money aside or saving in these accounts. Now, if you move further to the right, the third panel, you see that only about 10% of the population borrow money from these financial institutions over the past 12 months from the time of the survey. That's striking. And if you look at, so you can say, people might say, well, it's, really depends on a whole host of factors. There might not be a need to borrow. People just don't like going into debt, for example. But if you look at the set of bars on the right-hand side, these are shaded out bars, you see that actually 42% of those surveys have no access to emergency funding. And the way we define emergency funds is really 5% of basically per capita gross national income. So essentially it's quite low. So if you look at this more carefully on a country by country basis, so this is a set of charts that we have from a different research project that we have. And this is really on payment systems. And you can see basically the diamonds represent the share of population for those countries that have received or made digital payments. So they've used digital payment. And the yellow dots are essentially mobile phone ownership. In theory, these two should be closely correlated, but there's a gap. And if you look at the bars, the blue bars, which means represent active transaction, and then the pink bars, inactive transaction, a few things jump out. So here in Asia, some of the economies, you see that there are more adults that still don't make regular active transactions. And that's fascinating if you consider that against the context of the previous chart. Ooh, this did not come out very well, but let me just walk you through. Why is that? And what are some of the hurdles for that? So one thing that we found, and this has been talked about, is the cost associated with a lot of these transactions. So what you see here in Quite Busy is that we mapped the cost of credit card transactions, the cost of domestic transactions, and cross-border transactions, as well as credit-related transactions. And this is from the perspective of basically both consumers and businesses. And you see in Latin America, if you add up the two sets of bars, Latin America is seeing very costly transactions for these financial services. This is roughly about 4.5% of GDP. In Asia, it's a bit less. You probably can't see as well. But what we're seeing here is that the portion attached to credit, so this is the crossed out section, credit-related expenses, transaction expenses for businesses is actually the highest globally. So if you're a small business, this is something that's a hurdle. And even in places like the US and Canada, if you look at, say, the actual credit card costs, if you add up basically the bars associated for both consumers and businesses, it's about 1% of GDP. So it's quite costly. So one of the reasons that a large portion of the borrowers have no access, I'm going to move this back to the previous chart because it's better looking and it's not as busy. But one of the reason a lot of the borrowers or bank account holders don't access formal funding is because from a lender's perspective, they are just not economical. When you think about the different costs associated with making a loan, the margin associated with those loans has to be beneficial for the lender. So for a lot of these borrowers, and we can talk about this more, they're simply not economical. There's no business interest in reaching out to them. The second issue, the second hurdle we discussed in this paper is this issue of collateral. And this is where information, where data comes in. Historically, even now, if you're a business, if you need to borrow, because of this issue of information asymmetry, because as a lender, I don't know who you are, I don't have a clear sense for your creditworthiness. Quite often, to take out a loan, you have to pledge collateral. It's either fiscal collateral or security, whatnot. That provides options for recourse in case the loan goes south. But we know the young really doesn't accumulate capital until they're older, and the poor never do. So by default, the system, the risk management system that we set up, very reasonable motivations. But because of the setup, a sizable chunk of the population is effectively barred from official finance. And this is why in that World Bank graph, you can see 42% have no access to funding, and quite a few, 40%, 36% borrow not from these formal source, but informal source. I'm going to jump back. I apologize. So what does that mean? Where does virtual banking come in, and how does that help? A lot of you guys are much younger than me. So you are coming of age at a time when really access to this digital platform is second nature. You don't bat an eye when you turn on your phone, and you engage in social interactions with your network, and you do other stuff. Banking, paying bills, make phone calls, take pictures, post them. But what we're trying to show here is that there's this evolution of technology that allows the banking business to be transformed. What we're seeing here essentially is that there is an unbundling of services, so that when you go online, when you go to bank these days, including some of the virtual banks, you don't just bank, but you can do a bunch of other things that traditional brick and mortar banks cannot provide. And what that does is allow more people to be engaged, allow more banks to have more data point to work with. And in the end, what we're seeing here is really a rapid increase, quite impressive increase over the past decade in terms of financial inclusion, in terms of the number of people that now have access to formal finance. How is this possible? I mentioned earlier the whole idea of information capital. So in economics, we talk about this issue of information asymmetry. Now, many of you are perhaps certainly more knowledgeable about this than I am, but the whole issue of risk management when you give out a loan with traditional banks or traditional risk management framework is that you need to assess the creditworthiness of your borrower. And quite often it's a very two-dimensional assessment. How much loan you have? Do you pay on time? Have you defaulted? Your income, your ability to carry this loan. Usually that's about it. But what we're seeing now with this proliferation of online activities and the ability of technology to capture all these data points is that the profile of the borrowers can be more three-dimensional. Just a story, we were a few years back, this is before the term virtual banking became a term. We were, my colleagues and I were talking to back then it's called a B2B lender, online lender in mainland China. And this is a lender that's attached to one of the large platforms, companies, and they target migrant workers. And you can imagine from our perspective, this is the marginalized group of borrowers because they do not have steady income. They often don't have a steady address. They're quite often, more often than not, outside the formal system. But what they were able to do is based on their online activity, they were able to map out their spending habit, their income, and whether their credit access for that $500 purchase or some other purchase is something that they could be handled. And what you're seeing with online activities and virtual banking is that kind of knowledge base, that kind of harvesting of data and incorporating that data into the management of banks is multiplied in a much larger scale. So what does this new landscape look like? I have a snapshot, and this, I think, is now perhaps somewhat still representative of what we're seeing here. And you can see, based on our survey of virtual banks, all of them do the traditional banking businesses. They do payment, they take deposits, they offer loans. But many of them now also offer wealth management services, insurance. And if you happen to be attached to some of the banks, say WeBank, for example, which we discuss in some length in the paper, they also offer entertainment and dining options and e-commerce. You can go buy things and you can get on social media. So this is now, banking is becoming a lifestyle portal that allows you to engage with your life, with your financial needs, and other aspects of your life in a multifaceted way. Fascinating. This is very different from the brick and mortar bank that I grew up with. I don't go to Citibank or HSBC, and where I grew up in New York. So back then there was a sizable regional bank that's recently in the news. I don't go there to hang out with my friends or to buy things. I go out, I go to the counter to pay or to put a deposit. This world is very different from the brick and mortar bank. This world is also different in the ownership structure of who's behind these banks. So here we listed virtual banks in mainland China and Hong Kong. And we listed the names based on our survey when we wrote the paper. And based on this McKinsey survey, the main ultimate holders of these virtual banks. And the color codes basically represent the largest shareholder. These are the dark blue bars, blocks. And then the light blue bar, the secondary shareholder, which means that they hold less than 10%. And you can see that actually for the shareholders, a lot of them have incumbent banks as the largest shareholder, not surprisingly. They have the industry know-how, they know what it means to run the bank. Makes perfect sense. But many of these virtual banks also have big tech and fintech firms as the largest shareholders. And then in some other, in some instances, some other firms like non-bank financial institutions are also shareholders. This is interesting and different because now you're looking at banks that don't necessarily operate simply as a traditional brick and mortar bank. And you're looking at the ownership structure that is complex and it cuts across different industry sector lines. And that represents not only new opportunities, but also new challenges for regulators. So one thing I should just say, go back to here a little bit in terms of the virtues and the opportunities of virtual bank. So, I mentioned two big hurdles. I mentioned collateral and how virtual banks' information capital reduces the reliance on fiscal collateral and it broadens the reach to more borrowers. And the second hurdle is cost. Recall that slide on how expensive it is to really use many of these payment services and how that makes reaching some of the smaller borrowers uneconomical. Virtual bank is able to overcome both of these hurdles to some extent. And in our paper, we talked about this one case. We surveyed Hong Kong banks, virtual banks in Hong Kong, and we surveyed one virtual bank, WeBank in mainland China. And the reason we talked to them is because they are the oldest virtual bank in China and the first privately owned bank in China. And their model is fascinating. So they are, for those of you who don't know, they basically start out as a bank for SMEs. And they now lend to SMEs and lend to households. And the target audience, the target borrowers they have usually would not qualify for traditional loans because many of them are not terribly well educated. Their income threshold falls below what's considered creditworthy. And interestingly, from a cost perspective, the loan size of these borrowers is small. So when we survey them for retail consumer, a borrower, the average loan size was 8,000 renminbi on average. And the interest income WeBank was able to make from this 8,000 renminbi loan was 100 renminbi. For small, for SMEs, the average loan size is 265,000. Interest income for that, 1,500 renminbi. What brick and mortar bank can operate on that kind of margin? The second thing that was interesting is that, so we talked to them more and they said, well, the reason they were able to they're able to do this is because they have been able to leverage technology to lower their operating costs dramatically. So onboarding is basically instantaneous. They talk to a chatbot and it happens. Credit check happens within minutes. Quite often they don't interact with humans. And the risk assessment that happens on the back end is continuous, that leverage algorithm. Usually the number of transactions able to handle is several times of a traditional brick and mortar bank. So you can see through that one example, the promises of virtual banking. It lowers the transaction costs. It vastly improves the productivity and it broadens the reach of who can access financing, because now it's so much cheaper for a bank to provide financing. But what are the risks? What are the costs? I'll talk about the simple one first. This is a risk market concentration. No surprise here. The left-hand side is talking about the share of the big two in mobile payments in China. No surprises, I'm sure you know more than I do. Ally and WeChat now jointly control about 94% of the market. Enough said. In India, this is a chart on my right-hand side. It's similar story. Big techs, this is basically the pink bar, control roughly 85% of the market. So why is this concerning? My colleagues have, over the past 2 years, have come and been increasingly vocal about the risks of walled garden. And this is essentially talk about basically the idea that when you have the dominance of a few companies in a particular business, when you, particularly in this, this kind of model that really relies on access to data, what you're seeing essentially is when although the business model fosters inclusion, the inadvertent result is that these businesses put up walls, put up gates in terms of the data, the information capital that they have. That stunts competition. And it certainly could lead to, depending on how the algorithm is used, possible exclusion from the financial system and discrimination. So this is a risk. And the second thing related to walled garden is that, data holders, there are these, what we call externality. What they know doesn't just relate to the user themselves, but it actually affects the provision of services, not only for that specific incident, but potentially others in this platform economy. So now you can see potentially a situation where this type of discrimination gets amplified. So let's talk about some of these issues a bit more. And here's the third part of the discussion, and would love your thoughts on this. So there are challenges for regulation for virtual banks, and in particular, this kind of environment we are in, where there's increasing reliance on data and information capital. Well, one is for virtual banks, as mentioned earlier, the holding company structure. Who is involved? It's not just a bank anymore. It is held by perhaps the banks, maybe some non-bank financial institution, could be a hedge fund, could be some wealth management firm, and it could be held, as we saw, big tech companies. How do you react to that kind of ownership structure? And the second is the business model, as we mentioned earlier. It's not just banking anymore. So do you carve out the banking portion and regulate it differently? How do you think about the capital structure? Because they're all interlinked. I don't have the answer, and we don't know the answer, but certainly this is something that's crucial. But related to this issue is the pressing need for data governance and the framework for data governance. What do we mean? We have essentially now an ecosystem that's increasingly reliant on data. But who gets to access that data? And for those of us who generate this data, these data points, these information points, what sort of control do we have? And all the discussion we have right now about consumer privacy, how do you navigate and balance between protecting consumer privacy and at the same time allowing the economy to harvest and leverage the information that's embedded in all these data points? Not easy. So my colleague, I did not work on this paper, but I thought for the benefit of our discussion and given the debate on generative AI, I leveraged the work of my colleagues from a second paper on data governance, and the link to that is at the end of the presentation. So I'm going to try to do my best to summarize what they're thinking. So data governance is an issue. I'm going to go to the next slide just to lay out the lay of the land and walk you through, and then I'll come back to the slide as a summary. Why is that an issue? When you think about data, there are actually several entities, to put it crudely. This is all sound very sterile, but data subjects. Who are they? So this is the top light yellow bar. These are consumers and SMEs. These are the entities, people like us, that generate data. We're the subjects. Data users on my right-hand side are essentially the entities, the organizations that need to access our data. They could be a credit agency. They could be insurance company, a car dealership, whoever's looking to sell you their house, for example. And then the data providers on the left-hand side. These are the institutions that actually collected the data, your doctor's office, or your health insurance company who know all about you health-wise, the tax authorities, your income, your insurance, various insurance providers. So these are the different entities that are involved in this data ecosystem. But why is this a problem? When you think about it, the subjects, people like us, we have quite often very little control in terms of who sees what part of our lives. in my example, and again, I grew up in the US, and I remember signing various forms. I take out a credit card. There's this 10 pages of disclaimer and consent that I just signed. My accountant does my tax. And there's this very scary disclaimer about just signing all the private information away and stuff that my mother doesn't even know about. So quite often as a data subject, these consents are very broad and they're ex ante. I don't know when someone might pull up my car purchase history and what kind of car I bought. But maybe it will never be accessed, but it might. And I don't know who will access that. Well, that's a problem for me. The second issue is when you think about where the data is stored, it's siloed in different places. There's not one place. And I don't even know where some of my information is stored. It could be floating somewhere and I have no access to that and I don't know about that. And for those who need to, some of these data users who need to access this, they might not necessarily know where to access. That's costly from an efficiency perspective. And lastly, when you think about the data providers, the healthcare providers, the tax authorities, given this kind of system we're in, this kind of inefficiency, they're effectively, essentially the custodian of our data. They have control. That's not ideal. So this slide previously is to map out what are some of the concerns we have with the current system. So what is the solution? The solution is, here's one proposal that my colleagues put forward. So when you think about who gets to access data and how it gets accessed, there needs to be a foundational framework and principle, and that has to be privacy principle dependent. And what does that mean? That means that the purpose for accessing the data has to be limited. So you need to state upfront why this data is needed, for what purpose, specifically, not the entire life story, but really, I just need to see Sally's car purchase history to see what kind of car she likes and how long she keeps her cars. By the way, I haven't driven a car since I moved to Hong Kong. So that is blank. Data minimization. What does that mean? It really literally just means that only the minimally necessary data shared. You need to know my car purchase history, nothing else. Not my mortgage, not my credit card spending on Amazon, nothing else. Retention restrictions. This is crucial. It is about data portability, but not retention. What does that mean? It simply means that you tell me how long you need Sally's data for. It's not reasonable to say you get to see her car purchase history indefinitely. You don't need it indefinitely. So how long do you need her data to assess for assessment for analysis? 2 days? 2 hours? That's reasonable. Use limitation, again, very limited. When I'm using this, I need to know what kind of car she's buying because I'm looking to sell her a car. Maybe. Very specific, goes back to the purpose limitation. And lastly, a slightly different metrics, which is resilience, security. Because of the abundance of data and the dependence on data, whoever's storing the data has to make sure that that structure is secure. It's crucial. It cannot leave room for unauthorized access. And that ensures the level of confidence that this structure that we're proposing for data sharing is workable. And the underlying principle for this proposal is what's called the organs principle, as it says here. O for open, it has to be open and interoperable. Whatever you are looking at has to work elsewhere as well. It has to be revocable. That makes sense to me. If I granted the permission for someone to access my car purchase data, and if I change my mind, I get to change my mind because I'm the data subject. It's my data. I generated it. I own it. It has to be granular. This circles back to what we were saying earlier. It has to be small and specific. It cannot be all encompassing. You don't need to know everything. Auditable, transparent. We need to know what's been done. A notice. And this is essentially just a notice of consent. You cannot access, or I cannot access Sally's car purchase history without getting the explicit consent from Sally. And lastly is security. So this is the Oregon principle. So all this is fairly abstract and I'm running out of time. So I'm just going to quickly, in fact, I spoke far longer than I should have. I just want to run by one example that my colleagues discuss in their paper. This is based on India's experience. And again, it has the four entities. So I'll walk you through what's done here. So let's say a data subject is is interested in looking to initiate a data transfer because Sally is looking to buy a car and the car company likes to know what I've done with my previous cars. So I said, okay, so number one, reach out to a consent manager. This is an entity that's government run, non-for-profit, impartial. And I say to them that, okay, so-and-so, a list of approved data providers who knows who I am, and the list of data users who will need to see what I've done with my cars. I give the consent manager this list. So that's number one. And number two, the consent manager will say, okay, we will now reach out to these data users and say, essentially, we can now initiate a set of data transfer request. And number three is that request is now being routed from the data user that's approved back to the consent manager. And the consent manager gets my explicit consent from 4 and reach out to the data provider that held my car purchase history, number 5. Now, and the data provider will send the data to the consent manager, 6, and the user gets to go to the consent manager and see this. What's happening here is that all this is taking place with limited scope. They can only see my car purchase history, limited duration of access. They cannot hold it indefinitely. And this is taking place in a clean, controlled, secure environment where they can take a peek, take a look at this data for their analysis and leave. They don't get to copy and keep the data. And this is where the data consent and consent manager is crucial. So in this structure, you have data portability, you can see what's going on, you get to access data for your analysis, but you don't get to hold it and keep it. So to sum it up, my colleagues and I have, when we looked at virtual banking, it is something that holds tremendous promise for us. And this seemed to be the way things are moving, where now more and more of our lives are happening online, much to my chagrin, but also a blessing. And more these data points are being collected, and it has a way of revolutionizing not just how we interact, but how this data is harvested and used and leveraged for, in this case, financial inclusion. And we're already seeing sizable impacts from this. But there are also regulatory challenges, and we don't have the answer on this. Now, how do we go about navigating this new world, all the different entities? How do we go about thinking about data management? And part of the issue is, I'm speaking in front of experts here, so I'm stepping out of line, but part of the issue is the challenge is that we don't yet have a global consensus. Actually, we don't yet have, in some cases, national consensus, let alone global consensus on what an optimal data management framework is. So how do we go about navigating this world where now increasingly we're talking about the promises and perils of technology like generative AI? We don't have answers, but with that, I'll leave you the link to the two paper that my colleagues and I have worked on. I am but one of the people who worked on this, and we welcome your feedback and suggestions. Thank you.
Thank you very much, Sally. We don't get to see and appreciate the BS paper every day, so it's definitely fine if you want to overrun a little bit. I think it's fascinating. I have to tell you why I identified this paper. I was on sabbatical last year, and I had the privilege of doing a visitorship. And so I work for national, I work from Singapore for 3 months. I think it's better put it that way. And in return, I offered to give a public lecture. And when I was preparing for that, your paper came up as I was looking through the website. And it was instantly grabbing in terms of grabbing my attention right away. And it was inspiring for me. It provided a lot of information that I need to use to do the comparative study. And the last bit of your discussion, even though you have been telling me that your papers were written from economics perspective, the last bit of your presentation was actually screaming very loudly of the data protection principles. And you can find all those data protection principles from the PCPD's website. By the way, I have to tell the regulator here that that's the best designed website that I have ever seen. So much information and so rich. It's all out there. And so your paper actually incorporates the legal framework as well. So, so it's very rich, and that's why I like the paper so much. And that's why I wanted to talk about this paper. I don't know whether the audience have any questions. Yes.
Hi, thank you very much. My name is Sue Chan, and I'm very grateful that I'm here today because it's a very topical issue. We've had hacking into, government departments and the Consumer Council. So I was just wondering, Sally, you were talking about the consent manager framework for India. So what if the consent manager gets hacked?
All bets are off. Yes, I think you raised a really interesting and crucial point, right? It's consent manager, is our reliance on cloud computing when our accounts on cloud is hacked. It is, CBDC, central bank digital currency. We've seen some instances in some economies. Certainly should not name names in this forum. And I recall a few years ago, I was at a discussion with HKMA, and one of the deputy chief executive, Arthur, basically said, look, it's a given that the attacks on our digital infrastructure is now increasing at a pace that's alarming. So I don't have answer to you and say, what if it's hacked? All I can say is that this is crucial. In order for any of this to work, there has to be absolute confidence that what we generate and the data we have is stored and protected safely. That's why data security and infrastructure security and integrity, it is the utmost important consideration for banking these days, for bank supervision and just banking business operation. That's all I can say. And we have to, and the other thing I would say is that I think it is now perhaps, a given for business owners, banks, and regulators and policymakers to recognize the crucial role security plays because of the externality of not having it. Without the confidence, everything else falls by the wayside. There will be no participation in this new promising model. There will be no network effect of having more and more people enrolled in this new ecosystem. And the policy goals that you envision with these new technology like CBDC will not materialize if people don't adopt it because they worry about privacy and safety and security.
Any other questions? Yes.
Sorry. Hi, this is Raymond, and thank you, Sally, for your presentation. So it is a very insightful sharing on that. Regarding the virtual bank, for example, the virtual banks in Hong Kong, and because the PDPO, as mentioned before, is quite an old audience and very generalized, do you think it's a good idea, for example, to have some bank or even digital bank specific banking supervision be putting into the supervision framework so that instead of allowing their self-governance or self-regulated on the data governance issue?
I think as an economist, I'm definitely stepping out of line here. So I have to say, I don't have the expertise on this. Perhaps I can defer to Dr. Lee.
Well, I actually tried to put up a research proposal before. What I have found is the Privacy Commissioner's Office have been working with Hong Kong Monetary Authority for some time now, as well as the Hong Kong Association of Banks. So they are actually trying to, I know they have tried to put up the guidelines in order to provide insightful information as well as clear indication as to the extent of data governance that can be afforded to consumers, financial consumers. So that I think, yeah, off the top of my head, that's okay. I can think of, I can't remember the exact dates. If you look at Hong Kong Monetary Authority's website, obviously they have been paying attention to such issue, and there were circulars being issued in that regard. Yeah, like I said, I can't remember details as well as the dates, but it's definitely in the works. Yeah. Yes.
Thank you. I'm the Hong Kong Market Board member of the Ernst & Young. I'm also banking and consultant in Hong Kong. So thank you very much, Ms. Chan, for all your insight here. Three comments and also 3 questions from yourself. Number one is when you talk about the very low margin about the credit and also personal loan or whatever loans you just mentioned about that. I think the low margin is really because of the over banks in Hong Kong, because we have 166 banks at the moment. And I think, when we talk about, the banking returns in terms of the credit side, and I think this is all about we have too many banks in Hong Kong, not because of the virtual banks are not doing well. But what I would try to highlight here is, and I don't really get one thing is to really ease this kind of margin pain. What sort of suggestion from yourself can shed us light? This is my point number one. Point number two, on personal data, because you mentioned one of the point is the bank itself cannot hold the personal data indefinitely. Now, I'm afraid this is quite different from what I understand, from my career in the banking consultant side, because once you give the consent to the banks in Hong Kong or operating in Hong Kong, then basically, as long as you have the banking relationship with that bank A, B, C, D, E, then you basically give a continuous consent until time whether they accept you, they exit you, or you exit them. Otherwise, the consent is everlasting. So this is my second point. Number three is basically on the shareholders of the virtual banks in Hong Kong at the moment. I can see that you have a very detailed and very brilliant analysis of who the shareholders are regarding the 8 virtual banks. They're absolutely correct. The only thing is talking about regulators here, because our regulators are very professional and they are basically financial savvy in each and every dimension. But the only thing is, like, take some of my clients, I can't say whom, but the only thing is they don't came from a pure financial background. Some of them are telecom, some of them are whatever, you name it. But the only thing I want to highlight here, because our financial regulators, be it HKMA, SFC, Insurance Authority, because they know, I won't say they know nothing, but they are not a savvy in the area outside the financial sector. So, I mean, from the view of BIS or some other international organization, is there any suggestion that yourself or your expertise, your research team can shed some light to the further development of the virtual banks or other fintech development in Hong Kong? So thank you very much.
So 3 questions. One is basically on the business margin of banks and how to ease margin pressure, essentially. And you raised 2 points here. One is the low margin for Hong Kong is not necessarily because of, it has more to do with competition, that Hong Kong is essentially overbanked. And it's different from, say, an economy where it's underbanked, where financial access is far below what's considered optimal level. So there are 2 different issues here. I would say in our paper, what we suggest is we first recognize full well Hong Kong is a place where there is no lack of financial access. So our advice is primarily geared towards those economies where there's a funding gap, essentially. And in these situations, what we found essentially is that the leverage of technology lowers the operating costs. So in the case of reaching to, say, some of the migrant workers, for example, because their loan size is so small, because interest earnings on these are so small, it's not economical for many banks to service them. But what we found in our survey is that by leveraging technology, by reducing your overhead, the operating costs can be lowered in such a way that your low interest income can still be a positive margin. Now, the caveat, I should say, is everyone recognizes this. But for a lot of the, what we call traditional banks, brick and mortar banks, transitioning from your current IT system to a new system where you can have this newfangled algorithm that have chatbots and risk management system running 24/7 in the background is extremely costly. So the trade-off is, how do you migrate from a current system to a system that's future-proof? And that is the hurdle. And quite frankly, for a lot of banks, it's not that they don't know about this, but it's the difficulty of this migration. And this is why for virtual banks, as new entrants, they don't have the legacy problem. And that's why it's easier and cheaper for them to build a system from the way up, from the ground up. So I will take number 3 on how regulators should navigate this new environment, where we're now looking at an increasingly complex set of entities, participants, as well as issues, technology. And I have to say, I agree with you. It's a tremendous challenge because, just think about generative AI and the challenge it presents. Quite often, technologists will know what's going on with the data, with the technology and the drawbacks. And the regulators, supervisors who think about rules and regulations, and people who think about the broad implications on financial and economic stability are three sets of people. Three sets of different people. It's very rare to have overlap of any of the two, let alone three. And this is why, as people who study this, as regulators, I'm afraid that quite often we're just playing catch up. But doesn't mean that we give up. Doesn't mean that we don't keep on trying. That's what we do. And regarding your second question on personal data and the ownership and storage of data, and you mentioned that this is not indefinite, that once the business relationship stops, that exchange of data stops. I fully agree with you. I think what we were talking about in our data management framework is coming from the perspective of not the users or the data providers, but really coming from the perspective of the data subject, people who generate the data. And what we're really proposing is to give greater autonomy and control to the subjects through this setup called the data consent manager, so that the subjects can decide when to share, with whom, and for how long and what. In the current setup, as you described, the subjects have no clue if your banks A and bank B are sharing X, Y, and Z about the data subjects with each other. So it's a different structure.
Thank you. I think I'll just make a very short comment in conclusion. To answer your question in terms of competition, there's a point that I want to raise, which is probably beyond the scope of today's discussion, but it's definitely relevant. What I'm trying to explain is about the interconnectedness of virtual banking and open banking. Hong Kong Monetary Authority, for example, has demonstrated this point in the context of open banking. When they had this design in mind, virtual banking and open banking are connected. You can find similar examples in Singapore as well as in the UK. And Singapore and Hong Kong share a lot of similarities. One of them being like Hong Kong's banking system is predominated by the three largest banks in Hong Kong. Likewise, in Singapore, the banking system is also predominated by the three largest players in Singapore. In London, we would refer them to the so-called CMA9. CMA actually stands for Competition and Market Authority. CMA9 refers to the 9 largest banks in the UK. So from the regulator's perspective, one way to open up the competition is through open banking by allowing the third-party service providers, they being the fintech firms, technology firms, including big tech companies, as well as startup fintech firms. So as you can see, they have different financial resources in terms of capital base. They have different expertise. The smaller ones, they may be low on capital assets, but they may be high in terms of the technology level. And that goes on to the next topic, that is whether we want to make open banking mandatory. Because in Hong Kong and in Singapore, Hong Kong Monetary Authority takes a facilitative approach. In Singapore, they take a laissez-faire approach by letting the banks to decide whether they want to work with the third-party service providers. In the UK, it's different. In Australia, in the EU, they all adopt the mandatory approach. Otherwise, the rationale being, otherwise, the largest banks, they would have no incentive to work with the technology firms that are small in scale and they don't have the same capital base as well as the customer base, right? Because easily you have large banks, millions of clients. In Hong Kong, the three largest banks in Hong Kong, they occupy, they actually over 2/3 of digital banking, retail banking in Hong Kong. They control 3/4 of the mortgage loans in Hong Kong, as well as 3/4 of credit card issuance in Hong Kong. And that's why if you think about them operating on the scale, incentive is a very important issue. So that's why it's still at the very early stage of discussion. And just so we know, there are two different approaches, and it's probably bound to change at some point. Otherwise, there's no incentive for large banks to coordinate and cooperate with small players. But this is the idea of broadening the pool of competition and open up. By opening up the service providers, customers are likely to benefit because they can benefit from being able, having the flexibility to choose the service providers. And that's why we are running out of time. But when I was trying to talk with Sally in private, I was actually planning to lead the discussion in the context of silo problems, data portability, as well as data governance. So we'll leave it to another public lecture. Hopefully we can invite you back. Yeah, thank you very much.